Everyone seems to think that we're in a tech bubble right now, just like back in the 2000 dot-com crash. People are scared and have no idea what to do and think that the market's overheating. In this video, we're going to clarify all these things. Now, why should you listen to me? I was mentored by the Institute of Trading and Portfolio Management ex-Goldman Sachs traders Anton Creel and Edward Scheck, and the portfolio manager of Dragonstone Capital based out of Singapore, managing $3 billion. In addition to that, I have completed multiple specializations and have also created my own algorithm which is running in the markets, which has generated me over a 7,500% return over the last 15 years, all of which you can find in the bio. Do we currently have high valuations? Yeah. Are we in a bubble? No. The Mag 7 companies has a very strong earnings track record, and the numbers which are projected to be ahead are also pretty rosy. Mag 7 companies are also increasing their capital expenditure on research and R&D in the order of billions and billions of dollars because of chip research and data centers and the AI trade. They're increasing the capex like crazy. So capex plus earnings is really driving these crazy valuations we're seeing right now. Also, back in the 2000s, when the dot-com crash actually happened, tech stocks in the broad market was trading on a PE multiple from 50 to 80 times earnings, which is crazy. Right now, tech stocks are basically at 32 times earning, which is it's high, but absolutely nothing compared to what the dot-com crash, the stocks in the dot-com crash. Should you be concerned? No. Should you monitor it? Probably. A lot of people think that within the next 6 to 24 months, we're probably going to get like a broad market correction. And I'm probably in the same camp. The yield curve was inverted for most of 2022 to 2024, and it was a huge inversion. Everything that follows after a yield curve inversion isn't too good. The yield curve inverted in the 1999, in the 2007, and in 2019, and it just got out of the inversion in 2024. So the yield curve inversion might suggest that within the next 6 to 24 months there might be a broad market correction. Also because the Fed is cutting rates like crazy, and we're probably going to get like a huge, extremely high inflation number in the future. The Fed is probably going to start hiking rates sometime next year. So combine that with the inverted yield curve with the high tech valuation, that is good reasoning for why there might be a broader market correction. Are we in a bubble right now, and should you be concerned? No. You should probably be long the market right now and continuously change your portfolio as time goes on, and you want to time it correctly. Right now things are looking pretty good. We're not getting any rate hikes, nor is the market showing any signs of structural weakness. The only thing true about the bubble is because these stocks have a very high earnings or like a very high projected EPS number, and stocks basically move on EPS surprise or revenue surprise. That number is already pretty high. Now, these stocks can go down if there is like a slight guidance miss or like an earnings miss. Because these numbers are so high, it's obviously going to be a little harder to beat those numbers, at least by a surprise, a huge surprise. So, in the event that we basically get multiple securities earnings where they don't really outperform the analyst expectations like crazy, in that event, we might see something of a correction in the tech market in that case. So, in summary, we're not in a tech bubble right now, but I'd be cautious in the next 6 to 24 months because of an inverted yield curve, the Fed cutting rates like crazy and probably going to hike in the future. And I would also be concerned about whether if tech stocks might miss their earnings, then what's going to happen? Those are the few things we should worry about right now.